Now, if you have the back end of the Treasury market pegged to gold, redeemable in gold, and you let gold go higher and higher and higher and higher and higher through money movement, anytime money moves, it's backed by Treasuries. That is not the interest, not transferable. So the entities issuing the Treasuries take that and buy gold. Gold goes to the moon. The dollar collapses. So you save in dollars, you're dead. But it allows us not only to sell manufacturing to the world. That's Triffin's dilemma. In reverse, we can now sell our products to the world, and we can pay down our debt in a devalued dollar. And if gold continues to go higher and you sell a bond, a 50-year Treasury to start with at a fixed number of ounces of gold, well, today at just over $4,000 an ounce, it's almost 5,000 ounces on a $20 million bond, redeemable in gold. But the Van Eck funds came out, which is a mutual fund company, said if the dollar lost reserve stats, gold could go to 139,000.
The discussion centers on a growing belief that gold could play a much larger role in the future financial system. As confidence in debt-based monetary policies weakens, more attention is being paid to the relationship among government bonds, currency stability, and precious metals. The argument presented is that if gold becomes increasingly tied to the Treasury market, or serves as a confidence-building mechanism behind sovereign debt, its value could rise substantially over time. At the same time, a weaker dollar could be an unintended consequence of policies aimed to managing massive debt burdens. This creates an environment in which traditional cash savings may lose purchasing power, while hard assets gain importance. Andy Schectman, a precious metals specialist and longtime advocate for sound money, explains why institutional demand for gold continues to grow despite short-term market volatility. He highlights how central banks, sovereign wealth funds, and large financial entities have steadily accumulated gold while reducing dependence on dollar-based reserves. The ongoing expansion of stablecoins, treasury issuance, and monetary experimentation could create additional pathways for gold demand. If these trends continue, gold may eventually challenge many conventional assumptions about reserve assets. Looking ahead, one possible outcome is significantly higher gold prices as nations seek a neutral asset outside the control of any single government, potentially reshaping global finance in ways few investors currently expect. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
One of the things I've talked about a lot is possibility of, as Judy Shelton talked about, backing the back end of the Treasury market with gold, using the Genius Act and the fact that all money movement will be backed by short-term treasuries or stable coins backed by short-term treasuries. The interest isn't transferable. So companies like Tether have bought more gold with that interest that they can't transfer than anyone on the planet for the last 2 years except the Central Bank of Poland. And that Trump's previous crypto czar, he's now the CEO of USA Tether. Wink, wink, nod, nod. You're going to continue to buy gold with all of this interest, push the price of gold up, push the dollar way down. It's the only neutral reserve asset by which everything is measured. And with that gold, you will ultimately sell it to the Treasury so we can use it to back the back end of the bond market. But gold going higher, 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 higher with all the they keep buying it, keep buying it. Every time money moves, they buy it with the interest that is not transferable. They devalue the dollar, allowing us to sell product to the world. Gold goes to the moon, which then allows the back end of the bond market, because the front end is controlled by the Genius Act, the back end can then be controlled or sold with pegging to gold. Now, I've talked about that, and July 4th is when Judy Shelton said...
Do you think it's going to happen?
Well, I don't know, but here's one of the things that I found interesting. There's a man named Paul Winfrey, and Paul has just been hired or appointed by Kevin Warsh as his key policy advisor. Now, the interesting thing about Paul Winfrey, he's been around the block for a while. He's worked for President Trump. He's a CEO of the Economic Policy Innovation Center. He's a former Trump White House deputy assistant for domestic policy, and he's a Heritage Foundation scholar, all this stuff. But he, along with several economists, were tasked with writing something called Project 25. And it's the mandate for leadership. And his chapter was on Federal Reserve, where he seriously explores returning to or running a parallel system with a gold standard to fight inflation and the boom and bust cycles that he argues the Federal Reserve creates. He highlights gold convertible treasury instruments, aka gold bonds. That's what Judy Shelton talks about. So he talks about this as being a very, very good alternative to a gold system. When instead of the dollar being redeemable in gold, it's the back end of the Treasury market. Now, if you have the back end of the Treasury market pegged to gold, redeemable in gold, and you let gold go higher and higher and higher and higher and higher through money movement, anytime money moves, it's backed by Treasuries. That is not the interest, not transferable. So the entities issuing the Treasuries take that and buy gold. Gold goes to the moon, the dollar collapses, so you save in dollars, you're dead, but it allows us not only to sell manufacturing to the world, that's Triffin's dilemma. In reverse, we can now sell our products to the world, and we can pay down our debt in a devalued dollar. And if gold continues to go higher and you sell a bond, a 50-year Treasury to start with at a fixed number of ounces of gold, well, today at just over $4,000 an ounce, it's almost 5,000 ounces on a $20 million bond, redeemable in gold. But the Van Eck funds came out, which is a mutual fund company, said if the dollar lost reserve stats, gold could go to 139,000. That's their emerging market bond team who did this report. Well, that'd be 120 ounces at redemption. So gold goes higher. You can bring back manufacturing at zero upfront borrowing costs because the bonds are redeemable in gold or dollars at that time, but you don't have any upfront borrowing costs. You get the money, you build your manufacturing, the dollar keeps declining as gold goes higher, you sell your products to the world, you have new updated modern manufacturing facilities, zero upfront borrowing, redeemable in gold in 5, 10, 20, 30, and 50 years. As gold goes higher, the amount of gold redeemable becomes less and less and less and less. So not only do you have to pay less in the way of gold, way less, by the time the bonds mature, because it's a dollar amount fixed rate, but you also have the ability to sell your product to the world, bring back manufacturing, and do it all without defaulting. Everyone sees gold and silver breaking down. To me, they're not. They're shaking people out. Let's skip silver for a minute. I'll come back to it. But gold has been hit hard, and that doesn't mean the bottom is in. It means that we are entering the zone where fear often creates opportunity as sentiment is being washed out. But here's the key that people miss, and I've been saying this on your show forever. While the paper price is being pushed lower, the physical market is telling a very different story, right? We talked about Tether. They bought more gold than anyone but the Central Bank of Poland for 2 years, no matter what the price is doing. But how about the month of June? In the month of June, here, right now, over 2.9 million ounces of gold have stood for delivery on the June contract on COMEX, okay? And there's 289,000 ounces that are still open. That means contracts that haven't settled yet. And it ends at the end of June, right? So 2.9 million ounces of gold is over $12 billion worth. Who stood for delivery for $12 billion in gold on COMEX this month?
Then?
Because they knock the shit out of the paper price and stand for delivery at subsidized prices. Not only that.
They're subsidizing, though,
That's right. With paper money to buy the real thing. And not only that, over the last 30 days, 1 million ounces have left COMEX in the past 30 days, which means 1 million ounces, call it $4.5 billion worth, got on trucks and went, bye, see you later.
A major theme of the conversation is the growing disconnect between official economic statistics and the financial pressures consumers face. Rising borrowing costs, expanding government debt, and persistent inflation continue to challenge households worldwide. While policymakers attempt to maintain stability, the long-term sustainability of current debt levels remains a concern. The discussion suggests that higher interest rates may eventually expose weaknesses throughout the financial system, forcing difficult policy choices. At the same time, precious metals continue to attract attention as a hedge against monetary uncertainty. Gold remains the primary reserve asset in this framework, but silver is increasingly viewed as an overlooked opportunity. If inflation remains elevated and confidence in traditional financial assets weakens, both metals could benefit from renewed investment demand. Under such circumstances, gold may continue to set new highs, while silver may outperform due to its smaller market size and growing industrial demand. Now, let's get back to the interview.
There is no way to deal with these deficits without printing more money. And it's the fiscal irresponsibility is catching up with us because you try and raise rates and you destroy the entire system. But now it's coming to a point where the market is starting to push the ability of those who would like to keep rates lower higher. Since the war started, the 10-year Treasury is up 75 or 80 basis points. The Japanese 10-year treasuries at all-time highs. They're 30 years at all-time highs. Rates are moving up around the globe. Inflation is real and will continue to be an issue and will force the Fed's hand. Many believe it's called yield curve control. Many believe they will implement yield curve control, where they come in stealthily, create money to purchase the bond market on the 10-year side to keep rates down. But that's the beginning of Weimar Republic. That's how hyperinflation happens, as you just water down the money continuously when the government buys its own debt. But yeah, indebtedness is a very, very, very big problem. And when you mix that with record low savings rates, even a bigger problem. And, you know, these are the things. That's what I was
going to say.
It's about, part of it's about education. Like, I think half of these problems, Sarah, would go away if we started in kindergarten teaching the law of 70 seconds before they could even do multiplication and division, and talk about what is the rule of 70 seconds and why is it important to you kids. And most people don't know this, and it's just stupidity that the stuff we teach our kids but don't teach them what's really important. Most people watching this show right now will be like, geez, honey, do you know what the law of 70 seconds is? And their spouse or best friend will say, no. Let's listen. Well, I'll tell you what the law of 70 seconds is. You take the interest rate that you are being charged. That's why they normally start at 18% on the credit cards. 18% times 4 is what? 72. If you don't pay down your principal and you just pay your minimum annual or minimum monthly payment at 18% interest, your principal will double in 4 years. Conversely, if you owned a Treasury bond that was paying 10% yield return, in 7.2 years, your principal would double. In other words, you take the rate that you are being charged or are charging and divide it into 72, and it tells you how long before your principal doubles. And that's why when you look at these very, very high credit card yields, 18, 24, God forbid, 36% APR, in 2 years, your principal doubles. And that's the laws of compounding interest. And if we started with kids learning at a young age, to have the laws of compounding interest and the laws of compounding effort work for you instead of against you, maybe so many people wouldn't get so deeply indebted, and they would start saving much earlier and let those laws of compounding work for you. Richard Russell used to show this chart, two charts. One was a kid that started putting in, I'm going to get this wrong, but you'll get the gist, $5,000 a year starting at like age 15 or 18 and stops at age 24. Stops. 5,000, until he's 24, stops. The other guy starts at 24 and puts 5,000 a year in until he's like 65 years old. At the end, the first one outpaces the last double because of the laws of compounding.
Jeez, yeah.
And that last double puts him ahead of the other one who puts it in all of that time. That's why starting early is such a big deal. And that's why you see these predatory credit card companies on college campuses. You too can have a credit card, young lady. Sign on the dot. We'll give you a free book bag and a free mug. Go ahead and sign it, and you too can have a credit card. And then they start young and they get indebted. And this is how the credit card companies make so much money, through the compounding of interest that they're receiving, and how people get so far behind with not only credit card debt and auto debt, but student debt, which, by the way, is what? The largest asset of the U.S. government. As disgusting as that sounds, about 1.6 or 7 trillion on their balance sheet. It is a receivable. It is the largest asset of the country. So yeah, they know very well about the laws of compounding of interest. And when you see these adding up in an environment where rates have to go higher, they just have to go higher. If not, who wants to buy any of our treasuries that are of any length of time? And this goes into what we had talked about with Judy Shelton, using gold to re-inspire confidence in the back end of the bond market. But yeah, it's a big deal. It's a very big deal, and the consumer is stretched very thin, and it makes it much higher. People think they're going crazy because the federal, or the Bureau of Labor Statistics, the BLS, you should just cut the L right out of that and call it the BS, who produces the CPI, that it tells us inflation really is not so bad, right? It's bad, and it's worse than they tell us, because they strip out many of the things that are actually inflating. We've seen billions and billions and billions and billions and billions and billions of silver be delivered. And China is saying, I'll tell you what, U.S., we're going to put a 12% VIG. We're going to make it 12% higher in China than here. So a trader, J.P. Morgan, can say, geez, you know, we can buy what's called an exchange for physical contract, where you buy it here on COMEX and you exchange it for physical in Hong Kong on a COMEX contract to Brinks. And so it's called EFP. So you exchange it for physical, delivered in Hong Kong, where a truck picks it up in Hong Kong and delivers it to the Shanghai Exchange. At a roughly $11 increase on 10 million ounces, you just made $110 million. Yeah. China's bought more silver in the first quarter of this year than at any time in the history of the country. And they're the second largest producer on the planet. They're buying billions and billions and billions and billions, and we keep seeing these deliveries coming. Billions and billions and billions. Who is standing for delivery? Why is China taking all of it?
It doesn't scare you?
No, this is not weakness. This is accumulation under the cover of falling prices. Not even a little bit.
Another important point is the extraordinary movement of physical silver into Asia, particularly China. The discussion highlights strong buying activity despite price weakness, suggesting that large-scale accumulation is underway behind the scenes. Rather than viewing lower prices as a sign of declining demand, the argument is that strategic buyers are using temporary market weakness to secure large quantities of metal. This behavior often contrasts with retail sentiment, where falling prices can discourage participation. The broader implication is that physical supply could become increasingly important in determining future prices. If industrial demand continues to expand while investment demand accelerates during periods of economic uncertainty, available inventories may tighten faster than many expect. This could shift price discovery away from short-term paper trading toward the realities of physical availability. In such a scenario, silver could experience a powerful revaluation, potentially reaching levels that seem unrealistic today. Gold could also continue its upward trajectory as central banks seek monetary protection and diversify their reserves. While timing remains uncertain, the long-term trend described is one of increasing demand, constrained supply, and growing recognition of precious metals as essential strategic assets in a changing global financial order. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.